Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back at the end of the week for another weekly market recap featuring my good friend, portfolio manager Lance Roberts, who has only this discussion standing between him and a week of vacation. So Lance, we'll try to get through this as fast as possible.
I like it. Ready to go.
Okay. I shouldn't have said that. You'll probably just say done. You're probably just going to give one word answers now for the rest of the discussion.
Actually, I'm not even here. This is artificial intelligence. So
you say that. We're actually going to talk a lot about AI. And let's sort of start there, meaning optimism is back in the markets. It's been a big week. The trends that you and I have been talking about for the past couple of weeks have just been gaining momentum in terms of the very few stocks, many of which are driven by the AI narrative, just continuing to power higher. They're bringing the whole market indices along with them. What's going on here? Are we back to the era of irrational exuberance? Is there real staying power behind this? What do you think?
Oh, no, there's definitely staying power behind this. You know, I wrote an article 2 weeks ago now talking about the massive short position that was both in stocks and bonds, and that was going to provide the fuel that you needed for a rally in the markets. And all we needed was something to happen to kind of catalyze short covering in equities. And that occurred. The markets have been trading flat for 45 days. You've had a rising trend line from the October lows. So you had a very nice rising support trend line from the October lows. You've had a turn up in monetary liquidity. So if you take a look at the central bank balance sheets, those bottomed in November of last year, and those have been increasing. So we've had liquidity coming into the markets. And then, of course, just last week, we broke out of that 45-day consolidation period. And as soon as that happened, that fueled a lot of that short covering to start. And there's a lot of shorts that are sitting out there relative to the market. So every time this market advances, it's just going to drag more of that short position is going to have to cover, because again, at the end of the day, you know, there's a lot of negative. There's still a tremendous amount of negativity, but now you've got portfolio managers having to play catch up with the market in order to meet quarterly numbers. I'm writing an article for next week right now talking about career risk. And this is a big challenge for money managers, because if they underperform for too long, they either lose clients, lose money, or lose their job, one of the three.
Yep. When that's sort of one of the biases we've talked about in the financial industry is the proclivity to have to stay invested no matter what the market environment is. And sometimes that pushes capital managers to be in when maybe prudence says that they shouldn't. I'm making a little commercial here for financial advisors who have the courage to stay liquid against the herd if prudence calls for that. All right, so so first off, I want to give you your props here, where you've been saying now for really a couple of months that yes, there's lots of fundamental reasons to be bearish, but looking at the technical behavior of the markets and the potential for certain things like short covering and whatnot, that you've warned that, hey, you know, the longer we kind of hang out here in this compressed range, we may be building fuel that will ignite an upside breakout here. And that does seem to be what's happened here. You didn't say it was going to happen, but you said we really need to keep our eyes out for it. And I know you took some slings and arrows for that from the more pessimistic viewers. So congrats for sticking to your guns. I think so. You mentioned short covering was sort of part of this. Is it also just capital flows coming back in again? Like, you know, are people beginning to heal from their bruises of last year and saying, hey, there's enough positive momentum, I want to start putting my sideline cash in?
Absolutely. You know, two of the things, there's two reasons for what's going on. First of all, you know, you do have this AI chase that's going on, right? So it's the new AI revolution. And we've talked, like I said, wrote an article about this and those type of things. So part of that is part of this story here. And the stocks that are, you know, driving that chase right now are also just happen coincidentally to be the largest stocks in the S&P index. So we now have this passive indexing effect coming back into play, where 30 cents of every dollar that goes into the market is going into those top 10 stocks. So if I buy an S&P index ETF, 30 cents of that dollar goes into, actually 32 cents to be precise, 32 cents goes into Apple, Microsoft, Google, NVIDIA, those stocks, Netflix, Amazon, Meta. The other 68 cents, the other 68 cents is divided between 490 other stocks. So when you look at the performance of the markets over the last 3 months, and I actually, put a heat map out in our daily market commentary on Wednesday, showing, this heat map of the S&P 500, because these big green dots, in the markets of those top 10 stocks, and everything else is pretty much red over the last 3 months. So it's been a very narrow market advance. That's not healthy. That's actually the title of my article on Tuesday. Narrow markets aren't healthy markets, but it is a function of what's going on right now. And so, yes, you remember earlier this year, we had everybody piling into 5% treasuries going, if I can just get 5%, I'm happy. Now, all of a sudden, markets are returning a lot more than 5%. People are going, wait a minute, I'm locked in here at 5%, and I could be getting a lot more. And so we're going to start seeing, and then we're seeing this now, we're seeing a risk on, risk off transaction. Money was flowing into bonds. We're now seeing pressure on bonds at the moment. Interest rates are starting to come up a bit. Yield bond prices are coming down as money's rotating back into the equity market. So that non-correlation of risk on to risk off is very much in effect right now.
Yeah, in last week's headline for this this market recap video, I called them bipolar markets, and it really does seem to be that way, right? Everyone's rushing towards safety here, and then, whoa, no, wait a minute, the tech stocks are doing well. I'm going to rush back here, right? And
yeah, well,
usually, go ahead.
I was saying, I told you that was going to happen, and this is always the problem when everybody rushes into a safety trade. They think that I'm happy with 5% until the market starts doing really well, and then they run in the other direction. But it's FOMO, it's psychology, it's what happens.
Yeah, and this is why we always talk about it's our emotions lead us to make really dumb decisions as investors. All right, well, look, well, before I get to AI specifically, I was listening to one of your, market or your morning recaps that you do there.
While you were in the shower, I know you told me last week.
Yeah, I actually was, as creepy as that may sound to folks. And you were talking, I think that there's a buy signal out there now in the markets, which I think last week we were still in a sell signal, if I remember correctly. So this is a relatively new.
Yeah, absolutely.
How much do you trust this buy signal here?
You always trust it. Buy signals are buy signals until they're not. The only caveat to this one is that your best buy signals occur when you've had a big decline in stock prices. Obviously,
right. This is why I asked the question. So go ahead.
Right. So normally you have a big decline in stock prices, and the way the buy and sell signals work is they're an oscillator. So they move in an oscillation pattern, right? So when they get at a very high level and you get a sell signal, that's usually a really good sell signal that you're going to have a 5 to a 10% correction in the markets. Likewise, when they're at the bottom of that oscillation, that normal range of oscillation, or at the bottom of that turn up, usually that's a really good buy signal that's going to give you a 5 to 10% advance, somewhere around there. The problem with this buy signal is that it occurred right in the middle of that oscillation. That's not uncommon. That can happen. But what it suggests is that while the buy signal is valid, the upside of this rally of whatever we're going to get may be somewhat limited. So instead of this market going from 4,100 to 4,800, our upside to this market is probably something like 4,300, maybe 4,400. So the upside is going to be somewhat limited because we triggered this buy signal a bit early. There's also one other caveat to this. It also doesn't, there's also what can happen sometimes is that these signals, when they occur and they're early in the occurrence, they can provide a false signal and then roll back over. And sometimes that happens, and you just have to reduce equity exposure and then let the rest of the signal play out. But more often than not, because of the signals we use, we've smoothed them to a good degree. That's our money flow indicator that we talk about a good bit. We smooth that to try to eliminate some of those false signals, but you can still get them every now and then. But signals are usually pretty good signals to follow. And because of that signal, we were anticipating it over the last couple of weeks, and we've been adding exposure to our portfolio leading up to this kind of signal we got this week.
Okay. And given that it's not more like the classic one you like to see, kind of at the trough and you're going to ride the whole thing, is this a buy signal to be leaning into and buying to ride whatever's going to come in appreciation? Or is this more a buy signal of like, hey, time to unload as prices go up?
Well, That's an interesting way to put it. Whenever you're in the markets, when things get really overbought, you should always use that as an opportunity to take profits, reduce risk, raise cash. At the bottom of the market, you want to put that back to work. So it's just, that's the function of how the markets work. And this whole idea of just riding markets out over time doesn't really work out that well. But at this part of the cycle where we are, like I said, we've been adding exposure the last couple of weeks. We bought some Valero and some Exxon because energy was very oversold. That's starting to turn up. Fundamentals are still there. They're prone to a lot of stock buybacks. So we've added a little bit of exposure there. We've been nibbling on some regional banks over the last week. PNC Financial and Truist is an example. And then also we picked up some other exposure in the portfolio as well, adding AMD because of what's happening in the tech space and starting to increase our exposure on the technology side. So what we're doing, and I think I talked to you about this last week, is we're now shifting that exposure of the portfolio from defense to offense. So we're moving from more defensive stocks and inflationary positions back into the disinflationary kind of growth side of the market. So we're slowly making that transition in the portfolio, but we're also looking for opportunities of things that have been really oversold on a short-term basis. Energy is a good example of that because there's a good tradable opportunity there for a potential bounce this summer as we get back into driving season and those type of issues. So some of this is trading, some of it's longer-term investment themes, but on this rally, we're going to use this rally to start doing more of that transition, selling the defensive, non-cyclical, staple type companies and moving that back into the growth stocks of the portfolio on the next, opportunity of a decline in the market.
Okay. All right. Just to give a little commercial here, we're about to talk about a recent piece you wrote about AI. But then we will talk in a little bit about another even more recent piece you wrote that makes the argument that the bear market could possibly be over, lending additional validation to a more aggressive stance than you've had over the past year.
Right.
But let's get to that when we get to that. Okay, so this rally, as we talked about, is from a narrative standpoint at least, is heavily driven by the promise of AI. You can't turn on the news these days without hearing several stories about how AI is going to change the world. This smells a little bit like the fervor that we saw back during like the .com boom, which you talk about in this AI piece. Let me hand this to you with just the big fat pitch of like, how big a trend is this as an investor right now? Right. I mean, no doubt that AI is going to make a big impact on the economy at some point, but.
So it's interesting, when you think about AI as a function, there's a big difference between the internet boom and the AI boom, right? So the internet affected everybody, but it just gave us access to more information, made things more productive, but it didn't start replacing jobs of doctors, engineers, architects, lawyers, accountants, financial advisors. There's nothing that AI can't do. And this is going to be one of the big challenges going forward. And I was actually having this conversation on our radio show this week. When you think about the potential job losses that are going to come from AI, there was a recent study out talking about 300 million job losses, globally because of AI, but it could probably even be more than that. And then of course, the immediate fallback position is like, that's okay. If you lose your job because of AI, you'll go do another job. But the question is what's going to be that other job? What are you going to do? Well, people go, well, you got to have somebody to program the AI, right? Well, that's the problem with AI is that AI can program itself already, right? So it doesn't even need human assistance at some point down the road. The problem that this potentially creates is the continuing problem of even what the internet created, which is an increase in productivity that started pushing jobs and wages lower, right? So we started pushing people down the labor curve into lower paying jobs, and this is why where most of the jobs created today. It's in leisure, hospitality, restaurants, those type of things. So we keep pushing people down that labor scale, which is also putting pressure on wages. Yes, we've had a wage increase recently because of what happened post-pandemic. But if you look at wage growth over the last 20 years, it's been virtually flat despite rising inflation, these type of things. So, you can only look at AI and go, this is going to be dramatically worse. Now, here's the problem. And I'm fishing through this right now. I'm still, in fact, I'm writing another piece about AI for next week because this is a big macro investment theme, right? You are going to have to be involved investing in AI at some point because this is going to be the next phase of the market as we go forward. But we also have to think about the ramifications of this, because where do revenues for companies come from? They come from human activity, right? It's what we buy and sell and all this stuff. AIs don't buy anything, right? So if we replace engineers, if we replace architects, if we replace all these other jobs, accounting, finance, financial advisors, et cetera, we don't even need Adam, right? Because now with AI, we can do deep fakes and there's Adam sitting there talking to you with a script and you don't know it's not really Adam, but Adam's on the beach somewhere, just don't need it, right? So the question is where the revenue is going to come from to generate these sales that are going to support this AI boom going forward. And that's kind of one of the dynamics of to think about. I'm running through NVIDIA right now as an example of this. So NVIDIA did about $6 billion in sales, a little bit more than $6 billion in sales last year. Its current price is $313 a share. And that's not in the article you're looking at right there, Adam. This is on next week's article. But it's trading at 29 times price to sales. In order for price to sales to get to 10, NVIDIA is going to have to grow their sales by 480% over the next decade. That will make them they will have to have 30% of the projected global semiconductor market in the next 10 years. They'll have to own 30% of it in the next 10 years. Doesn't mean they can't, but there's a lot of other companies out there doing semiconductors, right? You got AMD, Broadcom, Applied Materials, Taiwan Semiconductors. You're talking about the whole global semiconductor market. NVIDIA is going to own 30% of it to justify that sales revenue. And that's a very, very tough measure for them to do. And of course, we have the Scott McNealy quote that we refer back to, often at 10 times price to sales.
That's what I was looking at earlier.
They can't pay taxes. You can't pay salaries. You can't pay anything. You have to have 100 cents of every dollar at 10 times price to sales to go to the investor. And that's just not feasible or logical. So one thing that's going to happen is that, yes, this AI boom is real. Yes, you need to participate in it. These booms can last for quite a period of time, up to a decade. Now and again, this is not new, by the way, just caveat here. The AI boom did not start last month. The AI boom started 10 years ago. So we're already a decade into AI. Google 5 years ago had a huge presentation that they did for all their employees where they revealed their Google Assistant. And at that time, they had this Google Assistant call and schedule a doctor's appointment for a person, right? And it was all live voice chat. Dialed the number, talked to the person on the other end of the line, scheduled the appointment, made adjustments for calendar scheduling, the whole 9 yards, hung up the person on the other end, never knew it was AI. But this has been going on for a long time. And so now everybody's like, oh my gosh, AI is it. It's here because of ChatGPT. And about 1 billion other websites right now that are out there that are doing everything imaginable, from creating YouTube videos to doing social media to creating PowerPoint presentations, writing Word docs, doing Excel formulas for you. It's all AI, and there's virtually thousands of websites right now all doing that. So the realization of investors is oh my gosh, AI is here. It's been here for a while. A lot of it's already priced into stocks, but it doesn't mean that we can't get a pretty significant boom in these stocks over the course of the next year or two. But valuations ultimately are going to matter, but they can get pretty insane before they start to matter.
All right. We're going to talk about the insanity in just a second. You kind of went in your answer straight to the punchline where I was going. So let's walk backwards here. So I have not studied AI nearly as much as you, but I have, I spent a lot of time trying to get an AI expert to come on this channel. The big guys are just so getting attacked by every media person that scheduling them is really hard right now. I'll keep at it though. but I have written for many years, as you and I have talked about, I think in previous videos, about the sort of the dark side of automation, robotics, and AI, which is sort of where you're going, which is, the technology so far has in the past couple of decades has really been a lot about disintermediation, right? Being able to take steps that were done by layers of people and get rid of the layers of people and make things a lot more efficient. Replace atoms with bits, as they used to say. That did disproportionately impact sort of the lower swath of the working class. It didn't hit the higher end, the more white collar part of the food chain. Part of that was really disinflationary, right? And we also combined that with offshoring, right? So, we really kept wages, a lid on wages for a long time. Now that we're looking at disintermediating the higher paying jobs as well, as you said, we have a we have an economy that's driven 70% by consumer spending, right? So if basically consumers start losing their incomes, especially the high income earners, well, what happens to that spending that's driving GDP, right? So you have that issue, and this is not a new issue. It's something that's been known about for centuries. There's always been these waves where new technology has displaced human labor, and economists have largely said, look, you want to do that wherever you can. If machinery can replace labor more efficiently and more cheaply, you should do it. But they've warned, and I think Keynes was actually the one who coined this topic. It's called technological displacement, the threat of technological displacement, where he says, if the rate at which you displace labor is faster than the rate at which you can redirect that displaced labor to additional productive use, you run the risk of creating a social crisis, the cost of which is larger than the savings that you're getting from the technology, right? And that's I think, sort of the specter of AI here, because AI increases at an exponential basis, and forgetting for a moment the risk or the fear that, hey, it's going to get so much smarter than us, it's going to end up enslaving us or killing us or whatever. Putting that aside for a second, it could increase so quickly that the displacement across all these industries happens faster than we imagine. And we have a ton of people that are idled, and we have this issue where we've just basically hollowed out the consumer spending base. All right, that's issue number one. Issue number two is, I've heard people, Charles Hugh Smith is a good example of this, who have talked about how there's this assumption, and I've read a lot of headlines recently about how much profit margins could increase for corporations because of AI, right? Because of all these cost savings, right? And let's assume for a minute that even the spending continues. This is assumption that these increased profit margins would be sustainable. But what it seems that folks aren't paying attention to is the fact that AI companies will compete with AI companies, and they'll basically compete away the fat margins in this space, right? Just because of competition inter-industry, prices will come down, et cetera, and whatnot. And so people think, oh, there's going to be so much profits that we're going to make from this new technology that can be reinvested into society, and we can all study art and, navel gaze and whatever. But that may be competed away. So my question is I could be wrong here, but I'm curious to get your thoughts on that. Do we have sort of this overly halcyon view of what an AI future looks like?
Oh yeah, absolutely. Look, all you do is, you don't have to go very far. Just go look at cloud technology, right? We're going to store everything in the cloud. And, initially, Apple was doing it, Google was doing it, and Amazon was doing it, right? AWS. And so every time they would report earnings, everybody would go immediately, okay, I know Amazon loses money on everything they sell, but what did they do in the cloud, right?
Yeah.
And those cloud margins were growing like crazy. And everybody went, oh, if they can just keep doing that for the next 50 years, well, own Amazon. Same thing for Microsoft and everybody else. Well, now now there's a billion people. I'm being facetious, but there's a lot of companies out there that all go, oh, wow, there's money to be made in cloud. I can do that cheaper than they can do it, or I'll do the same thing. It's just storage, right? You just buy stuff to store people, and
right.
You connect it to the internet and you say, okay, here, buy some storage, and there you go. So those margins are going to get crushed, and those are going to continue to get crushed to a large degree. And you're absolutely right about AI. And there's really two factors on the AI, profitability issue. And this was a point I was going to get to. Yeah, the expectation is that if you take a look at profit margins right now, we've reduced profit margins from its peak of 2021 by 100 basis points. But profit margins are still extremely elevated above the long-term growth trend of what the economy can generate, right? And so where do profit margins come from? It's a pretty simple mathematical formula. I have $1 worth of sales, I've got 80 cents worth of expenses, and I have 20 cents left over. That's my profit margin. My profit margin is 20%. So if anything changes in that dynamic, right? I have 80 cents of sales and 80 cents of cost. My profit margin is now zero. So this is going to be the problem with AI is that everybody's going, well, this is going to add 400 basis points of profit margins over the next 10 years. It's going to be just fantastic how much companies can make. Okay, well, that assumes a couple of things. One, that means that everybody's still spending the same amount of money they're spending today. But if everybody starts getting displaced out of their jobs, then what are they going to, how are they going to spend the same amount of money that they're spending today? So one thing to your point about technological displacement, there's a real risk that the wage pressure is going to continue. Again, if I can replace a high-paying job with AI, don't need to do it.
Right. Sorry to interrupt, but which you will, because as we've railed about in this program, we make the cost of employing humans so prohibitively expensive.
Yep. And so either we'll replace it with AI or we'll outsource it, one of the two. Just like what happened in California when they raised the minimum wage to $22, McDonald's automated an entire restaurant, right? Mm-hmm. So you're going to see a lot of that. So again, you're going to force wages down to the lowest common denominator. The other side of this coin is that the profit margins themselves are and exactly to your point, just like we're seeing with the cloud, is that as more people enter into this AI space, in order to get their market share, they're going to have to cut prices. And so the cost or the profitability of AI is also going to get compressed ultimately just through sheer competition. And so, there's, the expectations of a company like, and this is, look, I'm picking on NVIDIA right now because it's the darling of AI. Everybody's looking at NVIDIA. We owned the stock back in October. We sold it after the thing went up 100% in like 3 months. It was stupid. Now I'm stupid for selling it. So, but, now I got to wait for a pullback to buy it back, and we will. But, this is part of that, thesis, which is everybody's looking at these very specific companies like, oh, well, they make the GPUs and the semiconductors, and it's true. NVIDIA is light years ahead of other people in terms of, the products and the GPUs and the chips that they produce, and it gives them a huge competitive advantage. But there's still only so much out there to sell to. And when you're priced at 29 times price to sales, it's going to be very, very difficult to justify continually higher prices. And people are expecting the stock to grow 500-600% over the next year or two. And it may. I mean, FOMO can do crazy things to stocks. So I lived through the 1998, 1999 .com bubble, was there. I've seen all these bubbles happen, and they can have massively accelerated price advances beyond any type of logic that you can imagine. And we're in one of those bubbles. This is akin to what we saw going on with Bitcoin back in 2015. We're in that phase, and these price advances can be much greater than you expect, but it will end. And the only question is what time and when will it end?
Yeah. So, okay, we're going to get into a lot of anecdotes here for a second, but on that point, I mean, this AI market mania, I mean, really just hit the headlines really recently. I mean, we've been talking about AI, but all of a sudden the market just being like, AI is the future, right? I mean, we're weeks into this, right? Right. The .com mania lasted for several years. I know I'm just asking you to kind of speculate here, but are we at the very start of something that's going to get real crazy, or is history not going to repeat as much this time?
No, I think we're at the start of something that's probably going to get really crazy. Again, you can't really put it past what we've seen. Look, look at just what's happened. And now the question is, I'm going to spit this out. I'm sorry, I'm stuttering here, but I got a couple of thoughts that are competing with each other at the same time. Look, let's go back to 2020, right? 2020, we come in and we hit the market and the economy with all kinds of liquidity. And then it was all about meme stocks, right? So we're buying, GameStop was going to be the changer of the world in terms of, going to the movie. It wasn't, but that was what we were told. And so we created this huge bubble in meme stocks. Then we created a huge bubble in SPACs. And then we created a huge bubble in electric vehicles. This is just right. Yeah, exactly. Now there's a new one out called is it Pepe? The frog meme coin.
Yes, I haven't.
It's up like 7,000% since it came out. And the company even states that there is no commercial use for this coin. It is purely for fun and entertainment. And people are buying it. It's up like 7,000%. But this is the market that we've created. Robinhood, of course, going 24/7 trading on stocks. Now we've created this gambling atmosphere within the markets. And, there's a whole group of people sitting over here going, yeah, but valuations, pound on the table, yes, I agree. Valuations are hugely expensive. Valuations historically tell you a lot about what future returns are going to be over the next 10 years. But right now, nobody cares about valuations. Nobody cares about these things. It's, can I make money now? Because we've turned the market into a casino. And so the one difference about these bubbles, and there was actually, can I share my screen real quick?
Absolutely. Here, let me just give you the ability to do so. Go right ahead.
Bear with me just 1 second, because I wanted to just grab a tweet that I shared this morning. So I was sharing this tweet this morning, and this is an interesting chart that was put out by Bank of America. And, I thought it really kind of summarized what we're going through right now very well. And you can see going back to 1977. So this is going back 45 years, right? So you had the gold bubble that lasted about 9 years, but it really didn't last 9 years. And this is the important thing when you look at these historical bubbles, you have to look at the acceleration part. The acceleration part lasted about 12 months and then it was over, right? You go to Japan, that lasted about 2 years, then it was over. Asia lasted about 2 years, then it was over. The internet was 1998, 1999, 2 years, it was over. The housing bubble lasted about 3 years. It was a little bit longer, but housing's a slower asset, but it still lasts about 3 years. China was about 2 years and it was over. Biotech was about 3 years and it was over. So the point is that the acceleration phase of these kind of mania bubbles, they don't last very long. And then once it's over, it's over. They may flop back and forth for a while and then finally give up the ghost, but for the most part, they don't tend to last more than 2 or 3 years. And if you take a look over here on the far right-hand side at the very bottom, you can see the little AI bubble that just started. But that is going to kind of coincide with a secondary bubble in FANG stocks only because they're one and the same, right? So we talk about the FANG bubble that lasted through 2019 through 2020. It's 2 years, fell apart in 2022. It's going to rally again here. And it's not really, even though it's the same bubble of the FANG stocks, we're now kind of breaking that out into AI. They're the same bubble, right? And we're just going to call it two different things. It's still the FANG stocks because it's the exact same companies in FANG that are in the AI bubble, if that makes any sense.
Okay. Yep. So if somebody wants to play the FANG bubble, the AI bubble, might be one of the better ways to do it, to just be to buy a FANG, fund and run it. Yeah. I mean, I guess you could almost just buy the NASDAQ because it's 50%. Ththese companies, it's up 20% this year already.
Yeah. Yeah. And look, and that's, that's an easy way to do it. You could certainly do that. You can try to buy the individual players. The problem with buying like NVIDIA now, it's three standard deviations overbought relative to its both daily and weekly moving averages. Historically, if you go back in time and look at, when stocks get this overbought on a short-term basis, you're going to get some type of correction. It'll be a buyable correction, but you're going to get some type of mean reversion in the stock prices. Now, when I say that, everybody immediately assumes, well, Lance said it's going to go down 50%. No, just a mean reversion is a mean back to a reversion back to the 50-day moving average, the 200-day moving average, whatever it is. So, you could probably be talking, 10, 15% decline in the stock, and that'll be a great buying opportunity to add a company like NVIDIA to your portfolio. AMD, Broadcom, Applied Materials, Taiwan Semiconductor. There's a whole batch of stocks that are all playing in that same space right now. Of course, Meta's getting lumped in there. Netflix is getting lumped into that. Google, of course, Microsoft, Apple, because these are all the companies that are going to be basically using AI to enhance their products, right? So you can just kind of imagine with Apple down the road, instead of picking up your phone and asking Siri to dial your phone, you'll just talk to your phone and it'll dial whoever, it'll send text, it'll automatically generate emails for you, whatever it is. But that's the hope of what AI will eventually become, as a productivity tool for users.
Okay. Let me just ask you this. Is there like, yes, it's Microsoft and NVIDIA and these other companies that have been Google have been investing in AI for a long time, and they acquired these technologies and they're really making this huge tentpole of their future strategy. Are there any sort of like picks and shoveled companies in this space? Are there smaller providers that maybe haven't taken off to the moon yet, but are going to be servicing this industry that people are investing in?
Yeah, there are. They're just not public. There's just a ton of AI startups that are out there. Of course, this is now the new private equity playground as well. If you want to raise capital really quick, start an AI business of some sort.
Put AI in your business name. Yeah.
Exactly. And people will throw money at you. Doesn't even matter if the business has real viability, but that's just where we are. We're back into that kind of, there's so much money. And this is that other article that you want to go over. There's so much money in the system still that it needs a place to go, and it's just a function of time until it starts getting thrown recklessly at companies. And we've seen this. We saw it through the SPAC bubble, the IPO bubble. Private equity has so much money sitting in their coffers that they have to get invested. Remember, as a private equity firm, if Adam and I were going to be a private equity company, said, okay, we're going to start a private equity company, we're going to invest in these AI companies, send us your money. So you send us your money. You say, okay, Lance, Adam, here's my $1 million, go invest it for me. Well, we have a time frame that we have to go do that, because if we don't invest your money within a certain period of time, you're going to say, what are you doing with my money? Give it back. If you're not going to invest it, I'll do it myself or find somebody else who will do it. So private equity doesn't have a lot of time to sit around and go, well, I just don't see any really good deals right now, I'll just kind of wait. They've got a lot of capital. They've got to get invested. And the problem is there's not a bunch of really great companies to invest in. So what'll happen is they'll just start making a whole kind of shotgun approach to investing. They'll do small amounts in just a tremendous number of companies, hoping that one of them takes off and makes up for the other ones that they're going to lose money on. So there's going to be a tremendous amount of money that's flowing into that. And those are the ones that you'll either see acquired, like you saw happen with ChatGPT get acquired by Microsoft as an example. You're going to see most of that is what's going to happen. Most of these companies will never actually make it to market. There may be 1, 2, 3, 4, 5 that actually do. And those are the ones that'll be worth watching once they actually get public. But again, that's probably a year out or so before we see that happen, maybe a little bit sooner.
Okay. I'd like to take this moment to announce that Wealthion is rebranding as Wealthion.ai. And if you're one of my private equity viewers, just email me at info@wealthion.com. Our price terms are quite reasonable, I think.
And an AI will respond back to you in time.
Exactly. It does make me think that we might see the resurgence of SPACs saying, hey, give us a bunch of money, we're going to go buy AI companies with it.
I think that's certainly, people didn't really learn their lesson the first time around. They never do. So SPACs would not surprise me. That was a great vehicle that Wall Street came up. And again, we go back to that, and it was interesting because we talked about that early on, is that, when there's a lot of demand, this was the whole idea with the whole Reddit Wall Street Bets group, is that, oh, we've got the tiger by the tail, the retail trader is going to take it to Wall Street this time. And I'm like, no, you're not. Because as soon as they figure out what you're doing, they're going to start selling you product that they can capitalize on. And of course, that's exactly what happened. They IPO'd what they could, stuff they couldn't IPO. They're like, hey, these stupid people will put money into anything. We'll do SPACs. And, nobody's going to learn their lesson. Of course, we'll do it all over again, and we'll have another bubble that'll pop, and, that'll be part of it.
Well, this could end in tears. And I think
on that point, it will absolutely end in tears.
Okay, so I think you and I have been around for a while, and I think sharing some of our personal experience here is worthwhile. So there are a couple of things you mentioned. I took some notes here. I just want to share with folks. So we talked about how crazy these things can go, right? You said they can just really take off in crazy ways. So I went to Stanford Business School. I'm gonna tell a couple stories about that here briefly. One, when I graduated, I had a friend, and she and I were competing for the same two jobs, and we both wanted a job at the startup, and then we both applied for similar jobs at Yahoo at the time, and I ended up getting the startup job. So I took that. That's the one we both wanted more, and so she sort of, as a consolation, went to Yahoo. My startup got bought, but it wasn't really a financial windfall. Yahoo, while she was there, went bananas. And I remember we'd both been working for a couple of months. I took her to lunch. Yahoo had started, getting really interesting stock-wise. We went to lunch. I paid for lunch. When I got back to my desk after taking her to lunch, I realized in the hour that we were at lunch, Yahoo stock went up $100 a share.
Yep.
I mean, she made, I think, like $1 million while we were having lunch, right?
Yep.
Like, that's how bananas these things can go. And Lance, in your AI piece, you were making some comparisons to the .com bubble. You put up a Time magazine cover that I'm going to put up on the screen here, right? GetRich.com. So
Yep.
This came out the month that I graduated from business school. You see that there's some profile photos here at the top of this cover. Two of the people here were classmates of mine at Stanford. There were about four more that were mentioned in the article themselves.
By the way, that was not intentional. That just
Yeah, I know. You didn't realize you wanted to just twist the knife on me.
Exactly.
But yeah, you did. It was bananas. At that time, there was a guy in our class who was, while we were still in our last year of business school, was working with a startup called All Advantage. I don't know if you remember that company, Lance, but it was basically like a little browser buddy that served you ads on your web browser while you went across the internet. And they filed the S1 pretty much when this article came out. And based upon his shareholdings in the company, in the filing there, he was worth like a couple $100 million on paper. Like, this is as we're graduating. I mean, most of us hadn't started our jobs yet. This guy's already worth a couple $100 million.
It's important, though. You need to tell everybody what the date on that article is.
I'm doing this from memory, but I believe this was in May.
It's in the chart.
Oh, it's in the chart. September 27th, 1999. Was that when this thing came out? I guess it was. Yeah. So anyways, so right after this, just a couple months later, before that All Advantage actually got the chance to go public,
it was over.
The bubble had burst. It was over. That guy ended up making, those hundreds of millions evaporated. He got none coming out of that company. My startup eventually got shut down. We'd been acquired, but then we got shut down because the company was just in, survival mode at that time. I think I've mentioned a couple of times. I think it was like in like February of 2020. Oh, sorry, of 2000. It took me like an hour to get to work on 101, and it wasn't that long of a commute. It was like a 15-mile commute. I think by the time April rolled around, I could get to work in 15 minutes.
Yeah.
Right. I mean, it was like a neutron bomb had gone off in Silicon Valley. So it's just, I want to underscore how bananas these things can get incredibly quickly, but how you and I have seen how, they do end in tears.
I have a really good friend of mine to this day. We get together for lunch every couple of months, and every once in a while he'll wear a T-shirt that he made in 2000, and he had put all of his net worth into Yahoo in like 1998, and had made just a crazy amount of money with it. And he bought, and his one thing is that he wanted to own a Porsche. That was his whole thing. So it was like November of 1999, right? Yahoo. Remember, if you don't remember this, go back and look at a chart of the NASDAQ in 1999. At the end of 1999, the NASDAQ goes vertical. I mean, it is literally going vertical. I was going into my office in 1999. Literally, I would buy SDLI, JDS Uniphase, and Yahoo and stocks like that at 8 o'clock in the morning. I'd put pre-market trades in. The market would open. SDLI and JDS Uniphase would be up $100 a share at the open. I would sell them and go home for the day. I didn't need to do anything else for clients. It was just, but every day it was just like that, right? Yeah. It was just every day. And so you were
shooting the fish in the barrel, and they kept refilling the barrel every morning.
Exactly. So in 1999, he sold enough of his Yahoo stock to buy a top of the line Porsche GT, beautiful car, absolutely beautiful car. He didn't sell the rest of his stock. And about 9 months later, Yahoo is now virtually crashed at that point, and all the money it made is now evaporated. But he has a shirt that he'll wear every now and then. He says, yeah, I was in Yahoo in 1999, and this is all I have to show for it, which was the picture of that Porsche on his T-shirt. The important thing is look, and here's the point of that story, and the point of that article is that these mania phases can last a while, and you should participate in it. Don't be afraid to participate in it, because just don't forget to sell. And don't be greedy. Don't think these things are going to go to the moon, because they're going to seem like it for a short period of time. And it's like, oh man, I'm never going to have to work again. But if you don't sell this stuff, you're going to wind up giving back some, most, or all of your gains. And again, I'm kicking myself for selling NVIDIA earlier, but I couldn't justify at 24 times earnings or times sales, at that point that I could justify owning the stock any longer because of just valuation issues. Now it's at 29 times. I still can't justify it, but this is just part of that cycle we're in. So we can certainly speculate with it. Just don't forget to sell. That's the important.
And hopefully we'll have some time to talk about this before we have to wrap later. But so Sam Zell passed away this week. I did a video that just ran revisiting some of his final bits of advice, and he gave him one of his last interviews. And he cites a famous investor from the Great Depression. And the guy's last name is Baruch. Barry Baruch, I think, something like that. Has this famous quote that Sam Zell kept in mind his whole life, which is that, this goes back to your career risk part. He said, nobody ever got fired for taking a profit, right? So you can't kick yourself too much, right? The sin is writing it up and then writing it all the way back down, right? If you get out at some point in there, with a profit on the table, you're going to be okay. Yeah, maybe it wasn't as big of a profit as you could have if you had magically timed the market, top tick the market, but nobody gets to do that, right? The other thing you want to worry about too, or not fall victim of, is the Isaac Newton fate, right? Where he invested in the South Sea bubble, made a lot of money, got out, and then the crazy part happened. And he watched all his friends who stayed in get real rich, so he had to re-enter. And of course, when he did, the market cratered, and he ended up losing more than everything he had gained the first time round, right?
Yeah. The guy's name is Bernard Baruch.
Bernard Baruch, thank you. His friends called him Barry.
Yeah, it's interesting called Barry.
His good friends called it Barry.
Yeah, and actually, you bring up a good point. Every now and then, I publish I have an article that I publish about once a year, usually, about trading rules, and it goes through Paul Tudor Jones and Bob Farrell and all these guys. Just kind of it's kind of just a little good glossary of trading tips and kind of axioms that have worked well for big investors over time and what made them successful. And Bernard Baruch's rules are in there because it's a very good set of rules. But, it's always interesting that, people talk about buy and hold investing and all this. What's great about reviewing that set of rules, when you read through those investment rules of all these great investors over time, you'll find two things in common. They all may word it differently in some shape, form, or manner, but there's two things that you will find in common in every set of rules, no matter who it is. It's buy low, sell high, and not one of them ever talks about buy and hold.
Interesting.
Yeah. So I'll get that together. Maybe in the next couple of weeks, I'll publish that set of rules for you.
Yeah, great. And it's so funny because, you talk to 95% of the standard financial advisors, brokers out there, it's just all about buy and hold, right?
Yeah. Well, it's easy, right? I mean, look, if I could just give me money, I could just stick in an index and go play golf. It'd be great. It's kind of the running joke in our office is that, we're all busy all the time, working, and we're either talking with clients, managing portfolios, whatever it is. none of us play golf. And so people call us all the time. It's like, hey, you want to go hook up for a golf game? And it's like, no, I suck at golf.
Too busy freaking working. Yeah.
Yeah. I don't have time for that.
Hey, there's two last things I want to make on this. And by the way, we're still on my first bullet out of like 12. So we're hardly going to make a dent in today's agenda. But one of the things that really stuck with me coming out of the aftermath of the whole .com crash was, I mentioned I went to Stanford for business school, and the internet was exploding while I was there, right? Like when I accepted at Stanford, I mean, the internet was barely on people's radars. This was in, early 97. A few of us had been using it, but it hadn't changed society yet. It just blew up from the day I walked in the front door there up until, when we graduated, where all that craziness with time was going on. And so we had our 5-year reunion in 2004. Yeah. And we invited one of our favorite professors to the reunion to kind of give a keynote speech or whatever. And he did, and we were filming it, for the folks that couldn't be there. And at the end of his speech, he said, hey, okay, I've done my official remarks. Do you mind turning the camera off? And we did. And he said, okay, this is the part I can't say on camera. And he said, you should all ask for your money back. He said, we had no clue what we were teaching you at this time. Like, we were talking about eyeballs and, the new paradigm of the digital era. He's like, we were making it up as we went along. None of us had any understanding of this thing. And 98% of what we told you was just made up crap. Jesus. Yeah. And I think there's analogs to be made, yes, there's some smart people about AI, but I think nobody really knows, what's coming from here. You're going to get a ton of investment advice from people on how to play this. And a lot of it is just going to be people making it up on the fly here. So I think you got to be careful. And I almost think sort of what you're talking about, which is almost less trying to really parse out exactly what's happening with AI. You might just want to be a student of bubbles and manias and say, look, they tend to have this shape, they tend to have these phases. I'm going to try to play, the shape of the AI boom, as opposed to trying to understand the actual individual drivers of it. That might be a more smart way for the average person to play it.
No, absolutely. And look, it's really easy to do. And you can do this with some reasonable level of certainty if you follow the rules, right? So, and what I mean by that is, here's the problem that's going to happen. You're going to buy into the internet or this AI bubble, right? And nobody knows how long this thing's going to last. It could last a month, it could last 6 months, it could last a year, it could last 2 years. Nobody knows. I don't know. Nobody knows, right? This thing could turn tomorrow. And there's still the whole issue of potential recession that's still hanging out there somewhere, even though, there's more and more kind of evidence that maybe it won't be as bad as everybody thinks. We'll see, but there's still that issue. So there's a lot of things that could really, impact this whole market dynamic we've got going on currently. So what you do is you buy something like a triple Q or an XLK, something like that, to get you the exposure to those FANG stocks, or you just buy the FANG stocks and then just keep really tight stop losses underneath it. And then if the things crash, then you get stopped out. And you lose a little bit of money. That's okay. That's part of investing. Don't invest all your net worth in it, just whatever speculative portion of your portfolio you want, but just keep a very tight stop loss. You may get stopped out fairly quickly. That could certainly happen. But the where you're going to go wrong is that you're going to violate that stop loss. You're then going to convince yourself, well, wait, this is just a little bit of a pullback and it's going to keep going back up again. And then it's going to go down more. And then you're going to get into the trap of, okay, well, as soon as it gets back to where I was, I'll sell it. And then it goes down some more. And then you go, well, okay, as soon as it's going to bounce. As soon as it bounces back to where I was, I'm going to sell it. And then you find religion. And that's where you say, oh, God, please just let it come up a little bit and I'll sell it. And then you get to the point, it's like, well, screw it. I've lost so much money now. I'm just going to hold it and hope it comes back. But that's the cycle that exactly occurred in 2001 and 2. And I actually wrote an article about this. It's called "You Find Religion in Foxholes and Stock Markets."
And to be clear, that is the trajectory of every major asset bubble mania. Yeah.
But it's all about behavior. You got to control your emotions and be willing to step out of it. And if it goes, look, I'm telling you right here, right? NVIDIA. I kicked myself for selling NVIDIA. I did what was logically and technically the correct thing to do, but it has worked against me in my portfolio because of that. But now I've got to try to work myself back into that position at some point. But that's just a consequence of managing money and following rules. And sometimes that's going to happen, but you can't let your emotions override those rules, because that's where you wind up losing a lot of money.
And just on that point, you've got to change the way you look at it. It didn't work against your portfolio. It just didn't work for your portfolio as much as it could have. And there's a big difference, right? It's when you hang in there and you start riding the downside and then you start bargaining with God, that's when it's working against you, right?
Exactly. Yeah, no, it has hurt my performance by not having it, right? So my engine's running on 6 cylinders rather than 8.
Right. But the point there is you can still sleep at night, right? It's not like you lost a bunch of money. You just missed out on upside. And there's all the difference in the world in that difference.
But Adam, you know me, I'm just like you. I am uber competitive.
Oh, so. I know. But I'm trying to underscore the point you're making to people here, right? Which is, look, you live to fight another day. In fact, you're still better off if you get a gain. You got out early, right? But when you hold on too long and then you start, repositioning every time it goes down. I just hold on a little bit longer. And sort of my rule of thumb, especially if you're trying to play something is sort of a bubble, is once you find yourself bargaining, that's the time to get out, because it's only going to get worse from there, right? You're just going to you're going to bargain yourself to lower and lower prices.
Yeah, my rule of thumb is that as soon as I tell myself, well, maybe, or it might, or I use any of those kind of phrases of hope, that's my cue to get out right there. It's like if I say it might come back, or I hope it comes back, or maybe it'll do this, that's the time to get out, right?
Yeah.
Just right there. As soon as you start making up excuses, it's time to go.
Or when the voice in your head starts with, "Dear God, please," whatever comes after that, that's probably time. And so I really like your idea of the tight stops. I would say also just that, or work with an advisor who has a stated strategy that is working towards a model and is not letting, it's not a sentiment or bias or opinion driven position. It's just, hey, these are our rules and we're going to eject when the rules say Y or Z. The other thing that I'm kind of thinking of, and this is a little bit more speculative, so I wouldn't recommend it for many people, but is maybe just buying some calls and just letting the duration of the call be my discipline, right? Which is, hey, it's going to expire at a certain point in time, right? And I'm either going to have made the money or I'll have gotten out of it before then, right?
Yeah. So let me kind of share with you my one great experience with calls and puts.
Sure.
This is always my story about calls and puts. Markets have a way of knowing exactly what you're going to do.
Yeah, I know.
And so back in 1999, I bought puts on Intel, and I was like, "This is stupid. This stock is going to crash." And my options, I bought options that expired. This was in 1999. I bought options that expired in February of 2000, which was just right after when they were going to announce earnings. And I go, I'm going to make so much money on these put options. It's going to be crazy, right? It's going to be awesome. And my options expired worthless. The next month, Intel crashed like 70%. If I would have bought one more month, I would have made a lot of money on those Intel puts. But, that's the only issue with options, which I love options. We have a portfolio where we write call options and things like that. Just remember, importantly, when you buy an option, a 90% expire worthless. So just whatever money you invest in options, just you go in with the mentality, if I lose that money and it goes to zero, which there's a 90% probability it will, you're okay, right? Don't invest all your portfolio in that.
Right. And just to repeat, that's why I said this was speculative and I wouldn't recommend it for many people. Yeah, you do it with house money that, hey, if I lose, it's fine. The thing that worked against you there, and that's Murphy's Law, right? I mean, Murphy's Law. It's going to get you any way that it can. But and again, I'm not trying to encourage speculation here, folks, but you were on the short side, right? You were taking a put, and bubbles are killers, right? With the puts or with the short bet, timing becomes a lot more important, right? Where if my point is let the mania work for you here, right? Just be on the long side, give yourself some discipline, whether a tight put or just hey, it's going to expire in a month and I'm either going to make money or I haven't, right?
Right.
But anyways, and look, I say this like I've done this before. I've always been the guy who's been too afraid because he hated the mania and was sure it was going to burst. And I was always proven right. I just could never get the timing quite right. Right. All right.
Timing's there.
Let's move on here because there's a zillion things to talk about. I'm not going to talk about most of them for time, but I do want to get to your second piece here about the potential bear market that we've all been, I think, debating, and many have been awaiting its resumption here because we really haven't felt that the fundamentals have told a story of strongly higher prices, but that's what the market seemed to be wanting to be delivering here. And you're saying, hey, it may be more than just a market running on hopium. There actually may be an underlying factor here that's been underappreciated. It's one that we've talked about, but maybe not enough. So why don't you take it away?
So yeah, Adam, it's a very interesting thing. And look, let me just quantify what I'm saying here with this caveat, which is I don't know what the answer is. I'm trying to put some thought process behind kind of what's been happening in the markets versus what we keep expecting to happen. And when we go back, remember in 2022, you and I were talking about this, right? Inverted yield curves, all these things are going on. Recession clearly imminent in the economy, and yet it hasn't happened yet. First quarter GDP came in at 1.1%. Atlanta Fed GDP now for the second quarter is over 2.5%. Retail sales aren't falling off a cliff. And so this prediction of this economic recession keeps getting kind of kicked out further and further. And so, I've been trying to really put some thought into this and okay, well, why is this the case, right? So, we've all been looking at this from the function of like we did all this stimulus money and now it's been spent. And so now everything's going to crash because we've now tightened interest rates and, it's causing this credit constriction. And so consumption is just going to kind of die very quickly on the vine. Now, to be fair, we are seeing some of that activity. We are seeing consumption slowing. We are seeing economic growth rates slowing. So that is occurring. But overall, the economy still seems to be holding in here pretty well. And so, going back, I'm going, okay, well, why? What's potentially causing that? Why is this idea of this no recession, soft landing type scenario? Why is that seeming to be working out right now? And that's where I started kind of digging in. And when you take a look at the debt to GDP ratios, obviously, you see that huge spike in the debt to GDP ratio during the shutdown in 2020. Now, that debt to GDP ratio is coming back for only two reasons. One is that big surge of $5 trillion in spending is not being repeated. So now the deficit is reducing, not because we're spending less money, because we're actually spending more money. It's just we don't have that big surge in there anymore of that immediate impact to the economy. So that big jump in debt to GDP is declining only because economic growth is growing and the deficit is reducing. Again, not because of less spending, just because of no big major inputs. But that's also combined with this fact that we have this big surge in interest rates, which is also going to be slowing economic growth. So that all plays out exactly as we would kind of expect. And then when we start looking at, the underlying drivers of liquidity, and when we talk about debt, of course, as we've talked about before, debt is a deflationary animal. The more debt you have, the more interest service you have, the more that diverts money from productivity and productive investments. And that drags on economic growth. So the higher the federal debt to GDP ratio gets and the more debt that we issue, we're 31 trillion, we're on track to just keep issuing a whole lot more. So if we project that out over the next 10 and 20 years, get out to 2030, 2040, we're talking about economic growth rates below 2% on an annualized basis. That's obviously not sufficient to sustain wildly bullish financial markets. But and of course, this also goes into, household net worth. And we've seen this huge explosion in household net worth for the wealthy, not so much for everybody else. Mm-hmm. But this is all a function of all this spending. And so here's the point. The one reason that I can come up with that maybe is keeping the economy afloat at this point is simply the function that we have so much money, it's still in the system. It didn't come out. And the one thing that we don't really, talk about much is that $1.7 trillion worth of infrastructure spending that is now, this year, is now going into companies to start, green energy and, other, investments. It's going to municipalities to spend money, as well on stuff that they need to spend money on. So there's all this money that's still floating out there. So M2 as a percentage of GDP is still extremely elevated. And I think that goes a long way into explaining why you're not seeing this big slowdown in economic growth. And just between the fourth quarter and the first quarter of this year, you can already tell that federal expenditures have risen. So you can see that kind of that push between the fourth quarter and the first quarter of this economic kind of support of this kind of rising federal expenditure. So the money is still there. Despite the fact that we're seeing all of these slower rates of economic activity, and we've certainly got all these indicators that are suggesting leading economic has been negative 13 months in a row. That never happens outside of a recession. Yet we don't have a recession yet. And I'm not saying that we're not going to have one, but this is the conundrum that's going on between the financial markets. Markets have been rallying since October. And all the fundamentalists and economists going, oh, we're going to have a recession. That means earnings have to fall, profit margins have to decline, which is a very true statement, not arguing that, but it hasn't happened yet. And actually, if you take a look at earnings, and this is the subject of this weekend's newsletter, if you take a look at earnings troughed in quarter four. Earnings improved in quarter one. Earnings are expected to improve again in quarter two of this year, which we're going to start reporting quarter two earnings in just another month or so. So we're seeing all that. And when we talk about the markets from a peak to trough decline on a real basis, inflation adjusted basis, the market was down 27%. That's well within the context of a recessionary decline in financial markets. So now you're talking about, well, now have markets priced in this economic weakness in advance, which normally isn't the case? Have we front loaded that sell off in the market versus a more stable economic environment than what everybody's been predicting, right? And so this is the challenge. And look, as I said, let me be clear. I don't have the answers here. And, but what I am looking at is I'm looking at a market that has retraced back to its long-term growth trends going back to 2009, has held that support very clearly, has now broken above into a bullish fashion. We're continuing to break out to higher levels. The economy is not falling off the cliff. And this all suggests that if this is all the case, that earnings could well have stabilized over the course of the last couple of quarters. And we may have actually seen the bottom of the bear market. Now, again, we take a look at bank lending standards. That's going to lead to slower sales. That's certainly going to weigh on profit margins. It's going to weigh on revenue. If that continues to play out, we'll see what happens. But right now, what the markets are saying is that the worst of this is already behind us, and we'll have to see what happens over the next few quarters. But everybody expecting this big, massive bear market reversion is yet to come. Its potential may be disappointed because of all that economic liquidity we still have in the market.
I've been seeing headlines recently starting to refer to this rally as the most hated rally.
Yeah.
I know we had some relatively recent rallies that were called that before. And we haven't necessarily seen the kind of bubble euphoria mania that we were just talking about with AI. Like if that's still ahead of us, this thing is going to be just absolutely detested by people who are sort of, fundamentals focused.
Yeah.
And so
let me just clarify. I'm a fundamental guy, right? So, and this is, don't take that article and say, well, Lance is just uber bullish, right? As I've told you before, all these things that we write are us doing research. And what we're trying to do is just balance the bullish view versus the bearish view. I'm not overly optimistic about the economy as a whole because of everything we've got going on. And I still think that there's potential risk to this in the future. But, the differential is that I don't think we're going to have a depression. Right. So, there's a lot of people still kind of in that camp is that, oh, this is going to really end badly. And, because of all these reasons, and that may be the case, but I think the one thing we're all overlooking is how much money is literally still just floating around the system.
Well, and so that's the core that I took away from your article here, was that this is a pig in the python analysis, and you're just saying, look, that there's more pig still left in the python than we expected, right?
It is a really big pig.
It is a really big pig, and I've had people on recently, Dan Tapiero, Michael Howell come to mind, who are saying more declaratively, yep, the correction, we had our correction. The market, sussed out what was going to happen. We had the 20% drawdown in 2022. That's it. Things are improving from here. New bull market starting. Michael in particular, but both of them, say that we're net liquidity positive from here, which, to be honest, I'm still having trouble wrapping my brain around the calculation for that. So if you can shine some light on that, let me know, because what I'm curious is it just a matter that we had a bigger pig in the python than we expected, and so we still have all of that, injection of stimulus still sloshing around and supporting everything, or in addition to that, are they still like feeding the snake pork chops, while the pig's still in there, right? Are they putting more pork chops into the snake? So what's your take there?
Well, two things. One, here, let me grab a screen. I actually tweeted this. I tweeted two charts out in particular that really kind of go to the heart of what you're talking about. And this is also something that, as we continue to kind of process through, is thinking about this. So this was one chart that I tweeted out this morning, which was, this is the global central bank balance sheets of the Fed, the ECB, Bank of England, et cetera, and just kind of all laid on top of each other. What you'll notice is—
Sorry to interrupt. Up to when?
This goes back from 2002 to present. So this goes through April. I don't have May's number.
Through April. Okay.
Yeah.
Got it.
Through April. Well, what you'll notice is on that far right-hand side is that global liquidity from investment banks actually turned up, and that bottom is November of last year. So that bottom where the market, began to turn, in October. They kind of sniffed out that central banks were going to start easing monetary restrictions. And so despite all the talk, they've actually become more accommodative over the course of the last, several months. And we've seen that. And there's another chart. Let me just pause here real quick. Let me find it for you. So there's another chart out that also goes to this. And actually, again, you and I talked about this a little bit last week, but this is the change in the liquidity index. So this is basically the Fed's balance sheet minus the TGA, minus the RRP program, the repo program. And you can see that this market started rallying right when that liquidity index turned back up. And so we're seeing that, increasing liquidity, despite what the Fed's saying and doing, liquidity is increasing. Now, part of that's going to reverse when we actually get this debt ceiling deal done, because the Treasury's going to have to issue a bunch of debt to refund everything. That'll be a very small window when that occurs. It'll happen very quickly. So we'll probably see a small little spike in interest rates as all those bonds kind of get dumped on the open market. But then that's going to reverse very quickly. And I suspect that we'll continue to see this liquidity begin to go up. And then, of course, the other side of this coin was this massive net short position we have in the S&P, which is, as this market rises, that's going to continue to fuel further increases in the market. So you've got liquidity coming from not just central banks and the Fed, the government itself, but then you also have a lot of liquidity sitting on the sidelines in the markets. And don't forget is that all these people that have been buying treasuries, there's going to be a point to where they go, man, I messed up again. I went and bought all these treasuries at 5% and I'm missing out. And they're going to sell all those treasuries to go right back in the market. That's a retail side, so it's not going to affect the bond market much, but that's going to be additional buying that comes in as people realize they're on the wrong side of the trade.
Okay. Yeah. It's super interesting. Go back to the previous chart for 1 sec.
The Fed liquidity one? This one?
Yeah. So let's talk for a second about the Fed's, rescue measures that drove that big spike there in late March, right? We've heard that being described as not QE, right? And it isn't. And to me, the question is just, does it does that money somehow still get into the financial markets? And it's seeming like it may be, right? It's
Well,
whether directly or indirectly, it is helping to bring other capital into the financial markets here.
yeah, exactly. And I wrote one of my newsletters right when that happened back in March. I wrote in my newsletter that if the title of it is if it looks like a duck, and yeah, this is the loans that are being made to banks through that special facility when the Federal Reserve set that up to bail out Silicon Valley Bank. Those are loans. So basically, the bank pledges collateral to the loan to the Fed at 80 cents on the dollar, and the Fed loans them 100 cents on the dollar for liquidity purposes, right? To help prevent them from going out of business. That's not QE, but the market looks at it as QE because if it kind of looks like a duck and then it acts like a duck, it's probably a duck. And that's the way the markets look at it. So you're absolutely right. It's psychologically going, oh, the Fed is bailing out the banks. How they're doing it is irrelevant, but they're bailing out the banks. That means that we're not going to have a big banking crisis. So that removes that whole risk off the table. The whole debt ceiling issue, that was a contrived, issue between the Treasury and Janet Yellen and everybody else just to try to scare people. But the markets have already figured out that there's not going to be a debt ceiling crisis. We're going to resolve that issue. And so everybody's kind of front running these crises now. So they're figuring it out faster and putting money back to work in the market.
Okay. Yet one more reason, though, why people understandably hate this rally. If it's rallying off of QE, that's not really QE. It's just another psychological, magical thinking element, likely.
But remember, really quick, look, this is the most important thing. Remember, the market is just a herd of people, right? It's an organic biological conscience. That's what the market is. It's just a bunch of buyers and a bunch of sellers. The buyers think they're right. The sellers think they're right. And at the end of the day, they all agree to a price to transact some business. That's all the market is. So, yes, it's all emotional. It's all psychological. And yes, this is a hated rally. None of it makes any freaking sense. But that doesn't matter. You need to set that aside. If you're going to make money in the markets, you need to set that kind of thinking aside and just realize that the markets are being driven by emotional thinking. And, you have to participate with the markets when markets are going up. You have to get out of it when people are being irrational on the downside. But that's what managing money is all about, is adapting and understanding that what that emotion is happening. The fundamentals are important, but they don't drive the day-to-day movements of the markets, right? Those are two totally different things.
No, absolutely. And, we were talking about kind of comparing our scars to the, bets we made during the .com era. I was having PTSD flashbacks to some short positions I took against the FANG stocks in 2019 when they looked so clearly ridiculously overvalued and just continued powering higher through all that year. And then we had the pandemic and I thought, oh, well, this is going to bring markets down for good. I'm going to finally make all my money back. And then we dumped in $4 trillion. It all went into the FANG stock. So the point underscoring your point, which is, all that really matters is what the hive mind of the market thinks at the moment, and screw your logic, screw your fundamentals. And look, nobody has a crystal ball. We don't know where things are going to go from here, but you've done a really good job in these pieces of saying, hey, look, there are arguments to be made for why we may not have a bad recession. I hate to have the words come out of my mouth. We may have no landing, but in that we might not have this return to bear market that the fundamentals seem to be screaming we should be having here, but we may not for all the reasons we've discussed. And so I think the key thing here for investors to take away is no matter how much you might hate those ideas, if you care about, stewarding your wealth, you have to at least keep your mind open to the fact that they could happen. Because right now they are happening. Will they roll over? Who knows? But you've got to not leave yourself 100% vulnerable to that. If they do happen, it's going to materially injure your wealth prospects. So, as much as I hate to say it in many ways, you have to consider that these things could happen and you have to be allocating accordingly. And I think that's why, Lance and what his team do there at Real Investment Advice, and why I have Lance on this program every week, is to show you what a capital manager who is tasked with that responsibility is doing. Even as Lance said, he doesn't really logically understand, why we have the reality we do, but he doesn't have the luxury of sitting on the sidelines and saying, well, I just don't like it, right? You've got to dance to the tune that the market is playing here, right?
Yeah. And it's a very tough challenge. And, we're trying to do it as cautious as we can. I don't want anybody to think we're just throwing, willy-nilly to the wind here. We're still holding a lot of cash, too much cash. We're trying to allocate it, conservatively right now. And we're trying to get exposure to where we need to get exposure over the next couple of weeks. We're going to be making, changes to the portfolio accordingly. But that's how this works. It's a slow process. It's not an overnight switch, right?
Absolutely. All right. So I'm looking at the stuff we're not going to talk about because I'm going to start wrapping up here. But there are a few quick topics that maybe we could just touch on super briefly. We'll elaborate more deeply next week. One, which we don't need to talk about at all, but right before we hopped on here, Jerome Powell was interviewed in conversation with Ben Bernanke. We didn't really get a chance to recap that for folks. Maybe we'll do a deep dive on that next week to parse what those two guys said. Also today, Janet Yellen sort of surprised markets a bit by saying that she thinks that more mergers could be necessary in the banking system before things fully stabilize there. It was sort of a veiled way of saying, like, yeah, I expect some more failures here, right? So that freaked out markets a little bit. Bond yields. Oh, so forget the bond yields. Debt ceiling. So there was some news today on the debt ceiling. Lance, you probably know more about it than I. Maybe you can share what it is, and we can just talk about, update folks on your latest thinking on what's going to happen with the debt ceiling.
Well, basically just, look, we don't even have the real players in the room. By the way, McCarthy is not negotiating this whole debt ceiling. They have aides that are meeting. Biden is not, talking about the debt ceiling. They have aides on their side. So the Democrats have aides, Republicans have aides. They went to a room today. They all left, walked out of the meeting with no conclusion. So that kind of, worries everybody about the debt ceiling. The pressure is not on yet. We are not down to the final hour. So more theatrics going on in Washington. Don't worry about it. But and one of the reasons for the rally earlier this week was because both Biden and McCarthy came out and said, we will not default on our debt. By the way, there was a law passed in 1995 that says Social Security always gets paid regardless. So, all this, and again, talk about Yellen. She says more wrong stuff than anybody else. Never pay attention to Yellen. She's terrible. But anyway, it's going to get worked out. It's a function of time. We may run over the X date. That could happen. Markets could decline off that. And when we did that in 2011, we had about a 20% decline in stocks. So there is that risk, right? You cannot dismiss that risk of that happening. But at the end of the day, we'll get this resolved in some shape, form, or fashion.
Yeah, I mean, I feel like this is still largely kind of playing out according to script that you and I had laid out, weeks back, which is, look, this is an opportunity for the party that's doesn't have the majority, which is the Republicans right now, to demand concessions, right? You just you hold the debt ceiling hostage until there's enough visible stress, about it from enough constituencies that the dominant party has to say, okay, great, what's going to take, to make this thing go away, right? So that's what's going on right now.
Yeah, and just by the way, it's not just Republicans, it's Democrats. We've raised this debt ceiling this will be the 79th time since the late 1977s. And 49 times has been Republicans, and the rest of the time it's been Democrats. So this is everybody. This is not one party over another.
Right. That's why I was using party in power and party out of power, because that's just how the dynamic works, no matter how the power balance is. Exactly. All right. So bond yields are back on the rise. The U.S. 10-year has, in the past 2-ish weeks or so, has gone from 3.3 to 3.7% here. A question for you on this. So keep reading right now about how there's record shorts in treasuries right now. And I'm like, well, why is that the case? Because we've been talking forever about how the market has been anticipating this pivot, right? Yep. And so if you were expecting interest rates to go down, then you would be expecting bond prices to go up. So part of me is like, well, why are people thinking that way? Is it because of the mandatory refilling of the TGA and the bonds it's going to have to issue once the debt ceiling gets restructured? Like, why is everybody on the short side suddenly of treasuries?
Well, they're not short. That's not suddenly. They've been on the short side since last year, right? And this has been a very kind of protracted period of short. So a lot of this is portfolio hedging. A lot of it is, offsetting other trades, those type of things. There's also just a lot of, of course, then there was also the whole inflation issue. So inflation is still running fairly high right now, right? We're still running 4+% on inflation. So, inflation is still high. That's putting pressure on yields. So as inflation falls, yields will eventually come down. And, right now we've got pressure on bonds because of, again, markets breaking out. So you're getting this risk off to risk on rotation. So money's coming out of bonds to go into stocks. That's putting some pressure on that portfolio. That's also helping increase those shorts even more. So as interest rates come up, people keep shorting it even more. But eventually this is going to turn, and all that short position is going to be a big position of support for higher bond prices as yields begin to reverse.
Okay.
It's a function of time. It's timing.
Yeah. All right. Let me just ask the question one more time because I'm still not entirely clear. I get, hey, it's the other side of a trade, it's a hedge, it's a whatever, but why so many right now? Like, is there what is sort of the fundamental case for, I expect prices to go down from here? I mean, basically you're expecting higher yields in the future, right? Which seems to be at odds with like, the markets are the stocks are rising because it's blue skies ahead, right?
Right. Well, and so theoretically, again, from a theory basis, right? Stocks and bonds should be non-correlated. One is risk on, one is risk off. Okay?
Yep.
So if stock prices are rising, then you're going to sell your bonds to buy stocks. So if I have selling pressure in bonds, that means lower bond prices, higher yields. So there's that part of the equation. The other part of the equation is, yes, there is concern right now about, the TGA funding, of course, the whole debt ceiling crisis. You're getting people kind of hedging positions in portfolios potentially for a spike in interest rates when they have to do the debt issuance for that. There's also the inflation concern. There's also all those issues have kind of all compounded over the last 15 months. And that's where the short position's been building in the markets. And again, remember last year, bonds were underperforming by a large degree. We had the largest drawdown in bond prices since like 1788. Mm-hmm. So when bond prices go down, the natural proclivity of investors is, okay, those are going down, I'm going to short them. And they keep shorting them until they start rising. And so right now, bonds remain under pressure. So they keep shorting them because they just are under pressure. So if I'm hedging a portfolio and I'm long some bond position in my portfolio, I'm going to short treasuries against my corporate debt, my high yield debt, whatever it is that I need to hedge. So as long as prices are under pressure, they're going to keep shorting them. And this is the way it always is. This is why when the shorts in the stock market reverse, when prices run up, that short covering happens very fastly. They just have to be convinced that the downside risk is over. And right now, that's not the case in the bond market.
Okay. Do you see the bond market setting itself up here for a short squeeze at some point?
Oh, absolutely. Absolutely. Yeah. And why? Because it always happens. This isn't the first time.
Okay.
Yeah. We had a very similar short position in bonds in 2019 that was completely reversed in 3 months going into 2020.
Wow. Okay. All right. And just on this topic,
of course, yields went to zero at that point too. So 0.5 to be exact.
Right. Well, this is probably then a good segue into any trades that you may have made in the past week. Tell us what you've done, but I'm just curious on this bonds point. Does this give you confidence to keep pushing out on duration because you expect a short squeeze at some point?
Yeah, well, and we're not doing anything right now. We've added to bonds previously, but we're on a sell signal on bonds right now. So we're just waiting for that sell signal to process through, and then we'll add more to bonds at that point. So every time we get buy signals, we're going to keep adding to bonds, and then we'll just keep going from there. And eventually that buy signal is going to stick, and you're going to have a big reversion in prices. But as I said earlier, we've been adding a little bit to energy. We bought some ExxonMobil, bought some Valero on the energy side, just because it's really more of an out of rotation. Energy is extremely oversold relative to the rest of the market. I've posted some in our daily commentary. I've been posting some analysis on relative rotations and what's been happening in markets. And we've got a very skewed market. We have technology and communications that are very overbought, and everything else is oversold. So it's a very, very skewed market right now because of what's happening with the AI chase and this very narrow advance. So we're kind of nibbling on some of this really out of favor stuff just for a rotational trade within the markets. We did buy some AMD. We also bought some a couple of other positions in the portfolio over the last couple of weeks, just because we need to increase our equity exposure here because we are on a buy signal. So,
Okay.
But we're still holding a good bit of cash here. We're still probably, about 50% more in cash than we normally would be in this environment.
Okay. And just a reminder for folks that you do share the trades that you make in your portfolio through your Simple Advisor service that anyone can sign up for, correct?
Right. Yeah. So simpleadvisor.com has all of our portfolios in it. Every time we post a trade, we email that out real time so that you get notified that we made a trade. Also, but if you don't want to pay for that service, which is all of our research that we do, it's just, if you manage your own money, it's a great tool to help you manage your own portfolio. But we also post our trades every week in our free weekly newsletter that we have on our website at realinvestmentadvice.com. So at the bottom of that newsletter, every week we post all of our trades. All
right. Awesome. Just wanted to make, I don't repeat that enough on these things. And so I need to make sure people know that if they want to actually follow you in real time throughout the week, they can do that.
Okay. Absolutely.
Okay. Well, in wrapping up here, we didn't get to a ton of topics. I just want to mention real briefly on real estate, the National Association of Realtors, who are, perennially the most bullish people on real estate out there. They just issued a report reporting that U.S. home prices fell almost 2% year over year in April. That's the most they've fallen in 11 years on a year over year basis. So even they are admitting that downside momentum is continuing to build. Annually, sales were down 23% from a year ago. So again, downward momentum in that market in most markets, generally nationally continues. The standoff between buyers and sellers is going into extra innings here. It's going to be really interesting to see what comes out of that. We'll have to talk about that later. Layoffs, while they're getting pushed out of the headlines by AI these days, AI is probably still going to create a lot more layoffs. But anyways, they're not slowing down. And in fact, a big tech recruiting firm just came out and said tech layoffs are quote unquote far from over here. And of course, as we repeat every week, the layoffs have long contagions long spread outside the tech industry as well. So anyways, that wave is still continuing here. Maybe next time, one of the things that could be a little bit of a counterbalance to a lot of the stuff we talked about this week, Lance, is what's going on in employment. So maybe we'll do a little bit of a deeper dive in that next week. All right. And in just wrapping up here, I want to give folks just a glimpse into some of the interviews we've got lined up coming for next week. On Monday, we are going to be having our monthly live Ask Anything Q&A with all of our financial advisors. That'll be actually not Lance because he'll be on vacation, but Mike Leibowitz has kindly agreed to step in. We'll have the guys from New Harbor, and we'll have Jonathan Wellham, who's our new Canadian advisor there too, for you Canadian viewers to ask questions of. And we've got Michael Pinto coming back to the program. Folks have been asking for him for a while. Happy to say he'll be here next week. And David Rosenberg just agreed to come back on too. I have yet to lock in a date with him, but it's going to be in the next couple of weeks. So just want to give you a little bit of advance there. And, Lance, I got to say, my brain has a bit of whiplash during this conversation from our bearish and then bullish and then bearish and then, hey, maybe this bullish thing might happen. And I got to think that if I'm feeling that way, a lot of viewers have got to be feeling really confused, frustrated. And I understand that your role here is really just to try to make sense of the markets that we have, right? And I think you do a really good job of that. And as I gave you props at the beginning of this video for, a lot of the things that you were saying that were pretty unpopular over the past couple of months have been proving out true. And so we really do appreciate you sticking your neck out there and just trying to speak truth as best you calculate it from all your models. For the average person who's trying to navigate these models, these markets, I got to understand why, you probably just want to walk away in disgust most of the time, but that's not a successful strategy to building wealth over time. And so I recommend, as usual, that most people work under the guidance of a professional financial advisor, but not just anyone, one that takes into account all the macro issues that Lance and I talked about in this video. If you've got a good one who does that, great, they're worth sticking with. But if you don't, or if you'd like a second opinion from one who does, perhaps even Lance and his team there at Real Investment Advisors, Just go fill out the short form at wealthion.com to schedule a free consultation with these guys. They'll sit down with you. They'll tell you what they think you should do. It's totally free. There's no commitment to work with them. They just offer it as a public service. If you haven't done that yet, you should avail yourself to it. If it's been a while since you've done it, maybe schedule another one. All right. Look, Lance, these are great. I am going to stop here because I am fully aware I'm standing between you and your vacation here.
All right.
Real quick, I'll give you the last word, though. Anything you want to say to the audience as you head off into the sunset for the next week?
Yeah, no, I think you said something very well. Look, I realize that, when we're talking, right, it's bullish, bearish, and there's arguments on both sides of this, and it's confusing for me. It's confusing for my partners. It's confusing for everybody I work with. I know it's confusing for you. Again, we're just trying to navigate this and rationally think through all of these reasons. And as we've said before so many times, the biggest mistake that we make investing wise is getting locked into a thesis. And then the only thing we pay attention to information wise is I'm bearish, I only listen to bearish people, or I'm bullish, I only listen to bullish people. And so, I'm not bullish or bearish. And this is why, we have an eagle for our logo, which is, we're just sitting on top of all this and trying to analyze the bullish and the bearish data. Because once you get into either being bullish or bearish, you're locked into one side of the trade. That's where we make most of our mistakes. So I apologize for the confusion, but I hope you understand, and I hope you that it's important to have a view of both sides of the argument. So no matter what trades you're making, you can at least come at it with, okay, I'm going to make this trade, but I might be wrong because of this reason. And that way you can manage your risk better.
It's very well said, and you're making me think. So I want to remind folks, if you want to hear the observations that I give throughout the day and don't want to have to wait to each next video, follow me on Twitter. My Twitter handle is @MenloBear. From the inspiration from you, Lance, I figure I gotta somehow change that handle to @MenloEagle going forward.
There you go. I like it. Menlo Eagle. I like it.
All right. Well, look, folks, if you enjoy these weekly market recaps with Lance and I as much as we enjoy getting to do this every week, please do me a favor, support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, can't thank you enough, buddy. Have a very well-deserved vacation. Everybody else, thanks so much for watching.